Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. My guest today is Aubrey Linville of Linville Team Partners, a North Carolina-based commercial real estate brokerage firm. They're dedicated to continually reinvigorating the commercial real estate industry through embracing technology, innovative marketing, and a culture that supports an entrepreneurial drive towards client-focused success. We go all through the different asset classes that they play with, and it's a fun one right now. This is episode 321 of Zen and the Art of Real Estate Investing with my guest, Aubrey Linville. Aubrey is a co-founder and partner of Linville Team Partners. He has a 20-year career in real estate that has produced hundreds of deals across office, multifamily, retail, lots of different asset classes. I can't wait to get into it. Aubrey, welcome to the show.
Thanks for having me.
Yeah, I'm excited to talk to you. And I was just saying, I really like diverse assets because it allows me to always ask this, which one's your favorite?
Oh, man. So we'll jump right into it. I'd say my favorite is probably retail. I just
right
love,
now.
Right now.
Yeah.
Well, really all time has been retail.
Yeah, how come?
Well, I kind of give you a little bit of history. I started in residential real estate because that's all I could afford. I was buying foreclosures at the courthouse and
started like me.
Yeah, like a lot of people, right?
Yeah.
Buying a $25,000 house that, I could put 10 or 15,000 in and try and flip it and make 15 or 20,000 on the flip and then just reinvest it. And so, I always just had my eye on commercial real estate and was just kind of learning through osmosis, asking people, a lot of questions. There weren't podcasts back then, but reading any books I could get my hands on and just talking to brokers and, mentors, people that I trusted. And I always felt like commercial real estate, when you get to commercial real estate, you're in the big leagues.
Yeah.
And I felt like retail was what I understood the most because I hadn't been in a lot of industrial buildings. I had been to some apartments, just in college and whatnot. Didn't really understand office buildings. Typically, they were a lot bigger and kind of the smaller retail buildings were a little bit more achievable for me. And also where I probably spend when I'm not working, that's probably where I spend more of my time, with my wife or if I'm on vacation. We're thinking about where can we go eat? Where should we shop?
Where are there?
It just seemed relatable.
Yeah, you have kids too. So it's like, where are there multiple things that we can do at the same time, which is really what retail's about.
That's right. And as I got a little bit smarter with investing in real estate, what I like about retail is, I'm not a big single tenant net lease guy, though we do have some of that in the portfolio. I really like the multi-tenant strip retail where if you lose one tenant, it doesn't blow your entire investment thesis. So we own quite a few retail shopping centers for that reason.
In terms of businesses in there, what are like the size ranges? I mean, are these like 5 or are you talking like 20?
Anywhere from 1. I do have some single tenant, like I said, to 2 and 3. So we have shopping centers where we probably have 20 tenants.
Yeah. It's a nice spread.
Like power centers or huge mixed use centers. We do have an asset in Virginia that's a condoed pieces of a larger mixed use center. We really like that asset and it's performing well.
Yeah, it's interesting. My dad owned this 5-plex in New York that I eventually took over with my sister after he passed away. And we always really liked it. And I wonder if you think this, because you started in residential, I started in residential. My dad was in it. I know your dad was in it. But I'm trying to convince people now that commercial is okay to start with. And I really think it's actually a better option than residential right now. But I think still the marketing for everybody is like, you have to do residential. What do you think about that for new investors, even on the small scale, like how we started?
Interesting. For me, it was access to capital. I was like early mid 20s. I just didn't have much money, and commercial properties generally are larger. I wasn't smart enough at the time to understand how to syndicate a deal or to raise capital. It was like, if I was going to raise any capital, I would be calling like my sister or my parents or, a relative or somebody. And that wasn't all that appealing. But so I would say, I think the jury's out for me on which one's best, because I only know commercial now, but I'm seeing a lot of people interested in residential, and a lot of my peers own Airbnbs, places that are really doing well. The dollar size is a lot smaller. It's a lot more of a hands-on investment. But if you have the capital and you can buy a commercial real estate asset, I really love that. Let's just talk about like a 3-tenant retail strip center. Probably going to be close to home. If I'm talking to a peer that's considering investing in something just on their own for the first time, so you can find a retail strip center that's close to home. You understand the market, kind of know where traffic's coming and going from. What the market needs. You can look at an aerial in another market. This happened to me last weekend. I was visiting Charleston, South Carolina, and we had looked at a specific property, and on paper it looked really, really good. And when I went and visited, I realized, not really what it looks like on Google, even Google Street View. So to a new investor that's thinking about getting into commercial real estate and can afford a retail, small retail strip center, great entry point. They're probably going to know the tenants. They probably have shopped there, hopefully shopped there, will be able to shop there after they buy it, can talk to people in the market that they know and trust that can give them advice. And, the lenders in that market, they probably have relationships with some lenders in that market, maybe not through doing deals with them, but just from the golf course or riding bikes with them, or their kids are in school with somebody that they know. So I think that's a great place.
Local banks are incentivized to do that deal because it's so close to home and it is really part of community. It's like a little bit more accessible than a random house. But there's this distinction because now you're fully commercial and then most people are fully residential. But I always say that my favorite property is this mixed use that sits in the middle, the 2 retail, 2 residential. I just think it's magic. And I think it has opportunities because people can get in with owner occupied loans if there's more residential square footage, and then kind of have this hybrid property. And they often sit in areas that could either be Main Street, or sometimes they sit weirdly like, near these commercial strips where you're just like, oh, I think they have some apartments up top. And to me, that's a great hack because you can house hack that too. So you're kind of matching both of them. What do you think about that?
Oh, that's great. I mean, we don't see a lot of that product here. I know there's a lot more of it in more dense markets. And in those markets that I've gone and noticed that it's usually in a pretty cool part of town. A lot of, so you can live in a great, cool part of town, especially if you're a young investor and you can afford something like that. Like you said, great place to make your home. And you can really one of the things I love about real estate is it's tangible. You can get your hands on it. You roll your sleeves up and you can be the guy that's sweeping the parking lot or blowing the leaves off the roof or whatever it is you need to do. And just being accessible to those tenants as an owner, being accessible by those tenants is there's a lot of value there too.
Yeah, I think people are scared of the tenants because they think it's hard. And I'm not someone who loves being a landlord, but if I were to be a landlord again, I would want to be in on it. I would either be fully detached because it would just be something that I want to manage, but something like this, small retail, like we're talking about, I think you can only succeed if you're the face. I mean, because you want to figure out what businesses work, like you said, and bring them. And what I've always thought is great about small retail is you can really give somebody an opportunity to start a business. If it fails, you're going to find somebody else in there in most areas. And it really gives a chance to develop an area. One great new local business can spur 10 more. And that's the fun of it for me, at least.
Yeah. From a risk profile, a lot of people shy away from the mom and pop tenants, but we love mom and pop tenants.
I do too.
And we're I don't care what business you're in. We've all heard this a million times. It's a relationship business. And if you're going to have a relationship with your tenants, it's typically easier to have a relationship with the mom and pop tenants. And when things go south and you're never going to bat 1,000. Something's going to go south at some point.
Yeah.
Maybe not with every tenant, hopefully, but you're going to have something that goes wrong with the tenant. And, a mom and pop tenant, just when you get down to the brass tacks, a mom and pop tenant are going to fight harder to win than a national tenant.
Yeah.
A national tenant might have more, systems and processes and technology that maybe they can leverage and try and turn things around. But, if you've got a little mom and pop sandwich shop and things aren't going well, they're going to be out there beating the bushes, trying to do everything they can to bring the tenants to bring the customers in. And we really like that. And when you have a relationship with your tenants that's meaningful, they trust you, they can come to you with their problems before things implode. That's really important because sometimes, a little bit of rent relief can go a long way with somebody. And if you can figure out how to be, we talk all the time about being creative problem solvers. And with a mom and pop tenant, you can walk in their shop, have a conversation with them, understand what their struggle is, bring them a solution, and solve it right there on the spot. It's not going to real estate committee. It's not going up the corporate ladder.
Right. And they'll appreciate it. And the person who maybe owns some franchise of Verizon or something is just, they're a little bit offset from the product because they have to do what the overriding corporate says a lot of the time.
Yeah. Don't get me wrong. We love national tenants too.
Yeah. They're locked in.
They're locked in. Yeah. From a risk profile perspective, there's not a lot of hair on those opportunities when they're locked in for some term and they have good credit.
But that's just another great thing about, 3, 5, 7, retail. You can lock in a couple, bigger tenants, and then you can give spots to, and you have that nice mix there. Because look, people need to go to Verizon, because that's not a mom and pop type of business. So it's nice to see the diversification there. And like we were saying before, it gives you a couple things to do. If there's 5 places and you like 3 of them, that's a great stop, for everybody there.
Yeah. And you can take a chance on somebody too. When you've got a retail strip center, you might have your anchor or you might have an anchor on both ends and have a little bit of small shop space. And a small businessman, which I still am, but, didn't have quite the means 20 years ago that I do now. Somebody gave me a chance at some point, and it helps me get to where I am today. And it's nice to be able to give that back.
Yeah.
To a mom and pop tenant, a startup that maybe not able to do anything in a retail strip center down the road that's owned by a REIT.
Yeah, I think that's one of the greatest things about being a landlord that, of course, the news doesn't cover because they pretend all landlords are like Blackstone, and none of us own real estate when it's literally just all mom and pops. But you can do it even in residential. You have the opportunity to review someone in full and give someone a chance, if it doesn't work out, sometimes it's not going to work out. But I still think you'll feel good that you made an educated risk on taking a chance instead of the people who just take the first tenant without looking. I mean, that's just not smart.
Yeah. Sometimes the second gen operator that comes in with, the passion and the product and a good story, and they come in, they don't have a lot of upfit expense, not a lot of risk from the landlord side. They can come in and use what's there and give them a shot. A lot of times they're pretty successful.
Yeah. I mean, it's a great opportunity. So you grew up with a dad who was investing, but he was investing all over, right?
Yeah. So my father was a franchisee of putt-putt golf and games.
Oh, wow. Awesome.
Yeah. He had...
That's basically like an ATM, man.
Well, it didn't feel like an ATM at home. I'll tell you that.
It is a lot of upkeep and let's hear about it because that's crazy.
Yeah. I mean, I was really lucky to grow up in a family that was very entrepreneurial. Like I said, my father was a franchisee of putt-putt golf and games. He exited his business when he was around 50. He's mid-70s now. But what I saw was, a father and a mother that worked, sun up to sundown, or way before sun up to way after sundown, actually. And, they risked everything they had every day. And that was just life. I didn't know any different growing up. And, my dad would be gone for 2 or 3 months at a time, opening a new location. Oftentimes he would be the GC because, he could save money by doing that.
Yeah.
But when he was home, he was working at his office. He was, doing the finances, doing operations, just doing all this stuff. In hindsight, looking back on it, I got the sense that he was a bit of a pioneer in the industry. He wasn't just taking the franchise playbook and saying, okay, this is how they say you do this. It was more like, I think I can do it better this way. But so with that, he was always talking about the business, but generally at the dinner table, he was talking about real estate because his goal was to scale.
Yeah.
So for him to scale, he had to, pick a site in a new market. Like Raleigh, North Carolina is a great example. He opened a location. It was it was not a putt-putt. It was called Adventure Landing on Capitol Boulevard. And it was late 80s or so, I think. There was no technology back then that could tell you traffic count and demographics. And so I remember he had this 3-ring binder from Staubach that was like the demographics guru at the time.
Yeah.
And he went out there and he would just sit there and watch what was happening out there. And then when he came home, that's what we were talking about. So you repeat that 20, 25, 26 times. And so it was really, I was learning more about real estate on the entrepreneurial side than how to run a business. And so that real estate trail that he was on led him to, he opened a couple of Jiffy Lube locations. I think there were some Domino's Pizza real estate deals in there. He built a couple office buildings. He was just a hustler.
Yeah.
And on the back of this putt-putt franchise business. So that's really what got me excited about real estate.
On those franchise deals, was he? I've done a lot of franchise research, never bought one myself, but looked at it a lot. Is he buying the real estate on those and then he's just leasing it to himself, right? So he's really owning the real estate and then putting the franchise into his real estate. So if franchise goes south, cool, got this real estate, just pump up another business or sell it.
Yeah, I mean, easier said than done. I think that's such a unique build on these properties.
You can't turn putt-putt into Jiffy Lube in 5 minutes.
Right. Yeah. Like this property on Capitol Boulevard in Raleigh had, go-karts, miniature golf and mountains and waterfalls and a big arcade room with a laser tag and batting cages. And, so there was just, it was pretty specific. It would be hard to turn it into something else. But that said, the real estate is probably where he created more wealth than the operating company.
Yeah, that's what I mean. It's like the thing that because I grew up, my dad owned a lot of single family rentals, like a lot, and some commercial and office building type of things. And I knew all the tenants, so I was always around it. But I think as I got older, I started to realize, underneath all of these buildings is real estate. If there's a fire, you have the real estate. The real estate is really the thing that drives the value because that's the location. And that's, of course, what we're going to talk about for a lot of your commercial properties. Location is the key, no matter what sector you're in. Obviously, industrial plays in a different kind of location center for costs, but it's important for that because then they cluster around that. Don't you feel like that's kind of I think for people, they're looking at a lot of new form content and they're not thinking old school, like how we grew up where, there's actually land under every single business that's operating, out there. Even drop shipping companies, they have a warehouse. There's land underneath. Somebody owns it. And I think that's just an interesting principle to go on and obviously plays a role through all of the commercial assets that you guys look at.
For sure. I mean, back to the comment about it being tangible. You have tangible control of the asset. It's very different than the stock market or some other investments. I mean, you can influence the risk. You can influence the return. It's not dependent on market sentiment or what's going on. I mean, you have a business when you buy a piece of real estate. Yeah. When you invest in real estate, you're like investing in a business more than just, another asset. So, the more opportunity you can get in there, roll your sleeves up, the more value you'll be able to bring. And, it's like, it doesn't go away.
Right. It's there. That's what I mean. Even if you say that, Papa did well for 15 years, it's right. You couldn't just turn over all these mountains into something else, but maybe you've done so well over the years. Like you said, maybe the business was break even, did a lot, but there's a lot of costs that go in, a lot of employees. But then you have the land and now it's gone up so much because other things got built around it. Now you have a new option, or maybe you can turn around and sell it and you'll make a big profit on the land. Even though your dad was, getting up at probably 4 a.m, changing out like quarter machines and all of these things.
Yeah, he was definitely doing that. When he sold his business, he sold all the real estate with it. And, it's funny. I joke with him a lot. I was like, man, that might be the biggest professional mistake you made, because now you look at this real estate. He had such an eye for, where things were coming, because he might not have been able to afford the Walgreens corner,
Right.
back then, but he might have figured out, okay, 3 blocks down the road is where it's coming. This is the direction it's coming in. So he would go there. Now you look at some of the stuff and it's just, there's high rises around it, or it has been sold and torn down and there's something else on it. But yeah, there's a lot of value there that, had it not gone well, still would have been there for him to do something with.
Yeah, I wonder if you've seen this change that I've seen when it comes to like this type of product, this adventure land that used to really succeed based on traffic count and being in front of everyone because people would pull over. But over the years, my sister lives out near San Diego. And when my kids were little and her kids were little, we'd always go out there and we'd go to all these, trampoline parks and things. And every time we're like, where the hell is this? We punch it in. It's like in the middle of an industrial park. We're down all these things and you get there, huge open spaces, way less rent for them. And I've seen that happen in a lot of areas. Are you seeing that where you are, where these same businesses can now operate because someone can just Google it and go there? The traffic count becomes less important than maybe this huge savings for them. Maybe they're more profitable that way.
Yeah, I think that's what's driving it, is the profitability of the operation more than it's easy for them.
Yeah.
Trampoline parks are going into, dark grocery stores. They're going into, old warehouses, these paintball facilities going into old warehouses that are kind of dilapidated. It goes with the vibe.
They don't even have to do anything.
Exactly. But would they rather be somewhere that there's higher traffic? Yeah, probably.
Right. But the cost analysis, especially if you're starting that, will not work out. Yeah.
Yeah. Doesn't work.
Yeah, it's interesting. Retail is interesting. And those specific classes are really, like you said, your dad really asked, you are taking a risk and it is really a full-time business. But as you were saying, just buying one piece of land with anything on top of it is really a business. And that's what I think some new investors who get into it for maybe good tax benefits, they don't realize that a lot of times they're just signing up for a 9 to 5. I mean, if you buy a 2-family, a duplex, you're signing up for a new job that's 24/7 and you have to pay attention to it.
That's right. Yeah. For us, it was really important to us that we reached a sort of a critical mass with our portfolio to where the day-to-day management of the assets weren't our full-time job.
Yeah.
So that we could continue to grow our fund and, kind of expand our geographic footprint. So we're well beyond that point now, but you're right. I mean, to the first guy that's buying the strip center, that we were talking about a little while ago, they kind of want, a lot of times, you buy your first asset, and you kind of want that 9 to 5 job. You're like excited about it. And then after, I'm sure if you own a portfolio of residential properties, if you're managing them yourself, they say that the phone doesn't ring until 5 o'clock on a Friday is very true.
Right. Yeah. Well, because that's when everyone gets home and finds all the problems and you're just getting ready. Oh, it's time for dinner. No, it's not. You got to go plunge a toilet.
Yes, yeah. You're ready to go have a beer with your friends. And yeah. So, but the first couple of years, you were probably really excited to do it.
But that is one of the nice things. Yeah.
That is one of the nice things about commercial real estate, which typically is not true, at least what I've heard or seen or experienced long ago with residential. With commercial, a lot of times you can have a property manager in place and you're buying it based on an NOI that has, property management already in it. So so you don't get the calls at 5 o'clock on a Friday as much, but you still have the opportunity to build relationships.
Well, generally, commercial is going to have less bathrooms, so that's always a good thing. Less things to overflow, and better long-term tenants who are really taking care of it. A lot of commercial, they're going to do their own build out, so they handle their own maintenance, and they really only ask when there's an issue with something overriding.
Yeah, it's funny. I've had friends ask me, "Hey, look at this look at this duplex. What do you think? It's a 10 cap. And they're like, let's dissect the NOI.
Yeah.
Like, well, where's your turnover cost? Because, you turn these tenants over every 12 to 18 months.
Yeah.
And you're not going to make any money. You're going to be feeding this thing.
I just think it's funny when people talk about cap rates under 5 units because it doesn't apply. They're going to be comped out by residential comps anyway. So that's a great, right. It's a smart presentation by the agent or broker, but it's not relevant to these smaller properties. And like you said, way different management, especially if you're buying into existing tenants. Can go either way. I've seen it a million times. You might think it's great, but you never know until closing. Hey, it's Jonathan. I hope you're enjoying this episode with Aubrey Linville. And if you're thinking North Carolina might be the place for you and you're interested in commercial in the Piedmont Triad and surrounding regions and want to get in touch with Aubrey and his team, go to ltpcommercial.com. You're going to be able to find whatever you need there. And now let's get back to the rest of the show where we talk more commercial assets.
Is your portfolio in California where you mentioned, or is this somewhere else?
Yeah, now I've gotten rid of most of it over the years. My dad had a big portfolio that my sister and I took over mostly in New York. New York. And then my sister didn't really want to do real estate anymore, so we've sold off most of it. And now I invest passively now more in syndications because I'm turning 55 this year, and it's like I finally saw the light, about a year and a half ago. Like, why don't I just trust experts to do this stuff? I kind of rid myself of being active and ego. So now I'll look at short-term rentals now because I'm ready to just play and have a fun thing. But I don't want to be as active as I used to be. And I'm seeing the light for newer investors that there's ways for them to get into more passive opportunities. I think because there's going to be high earners who maybe aren't going to buy a home now. They're going to keep renting and they want to deploy into something. And there's a lot of passing, what I think is really passive, which is syndications out there that could really help them. What do you think about that? And what's your investor base look like in terms of new and experienced?
Yeah, you hit the nail on the head, really. I mean, we are experiencing that here. The demographic of our investor base is pretty wide, very high net worth to just enough to be accredited.
Yeah.
So it's kind of across the base. And with our fund, our first fund, our minimum was $50,000.
Yeah. Traditional.
Pretty low entry point. And some people are like, I don't want to mess with it. I trust you guys, but I do want to invest in real estate. I understand enough about it to want to invest in it. So they'll invest 50, 250, 500,000, whatever the number is that they can afford. It's interesting. We also have a lot of people who have been serial real estate investors that are in their mid 40s that are peers that are like, man, I just don't want the 9-to-5 job anymore.
Yeah.
I'll give up a couple points. On the return to just have a passive investment, and what our people love about us is, which we'll probably get to at some point in the podcast, but I'm late 40s. We like to have fun. We're very relatable. We over communicate. And that's really what people are looking for. They want to invest with people that they trust, that they want to be around, that they want to hear from, in properties that, that are tangible to them. Like, so our geographic footprint is North Carolina, South Carolina, Virginia. So everything we've bought, you can drive to.
Yeah.
And most of our investors are within a 30 or 45 minute drive of our headquarters here in Winston-Salem.
Yeah. It's nice to be able to see the properties, even when you're passive. For me, the way that I look at it in my passive investments and syndications, it's like, well, now I have a piece of these geographical markets, and I also have a piece of asset classes that I have no interest in doing on my own. For me, it's all multifamily now, but I like self-storage. I've tried to buy a couple with my friend. I could operate that, but why don't I just let somebody do it and then have part of something bigger where they've done it, 9 times. So I really see the value, but I've been pushing it to newer investors who I know are well qualified, because I just feel like the old things that we both did, starting buying, dumps, fixing them up and scratching away 15,000, and that wasn't even worth it. People are still trying to do, but the prices are so much higher now. The fact that someone would do a flip now with no experience is just crazy to me. when if they were accredited, they could just put 50,000 and then that's a hedge against themselves. It's like, okay, I'm going to need 5 to 7 years, but I'm going to make some steady money. And then I'm probably going to double my money or more in the end if they can just be patient. So it's really, how old are you until you get patient? And most people, it takes us a while.
Yeah, I'm getting more patient with every year.
Me too. But it's also the lack of, we don't want to do the stuff that we've been talking about. I don't want to do the toilets. And like you said, you build up and then you have management that you trust so you can go on and do bigger things. And that's the thing. If you're always active managing, you can't scale. It's impossible. I mean, somehow your dad did, but he was always gone. And that,
he had great managers.
Yeah.
He had great managers. But it's your comment about being passive and it being tangible. It's a great example for us. We really do view our LPs as partners.
Yeah.
And we value their input and their opinion. It's not give us your money and shut up attitude. Everybody that invests with us, we have a prior relationship with. It won't always be that way.
Yeah.
But it is now. Great example. We were nearing the end of diligence on a shopping center in Virginia that we acquired, and a guy, committed several $100,000 in this deal specifically. And he emailed us on a Monday. He said, "Hey, after I committed on Thursday, I drove up there. I spent the weekend at the shopping center. Here are my findings." And he sent us an email that was as good as you hire a third-party due diligence company,
that's awesome.
which we don't do, but it was like. Yeah, I stayed at this hotel. This is what the person at the front desk told me about the market and the shopping center. I shopped at these 5 different retailers, and this is the information I got.
That's invaluable.
I was like, man, this is great. We love that. And not everybody does, but we love that. And it was just great feedback. And quite frankly, he uncovered quite a few things that just happened to be uncovered that weekend while he was there, and it's driven a lot of value for us and how we think about the asset.
Yeah, but I also think it's how you, like you said, you over communicate and you're building relationships. Not all syndicators are like that. GPs sometimes are standoffish. They got so many opportunities. They don't build those relationships. But I think when you do, then you get this opportunity, for someone to give feedback. And if you're receptive of it, wow, you can really do something big. And then that person's going to feel more involved. For me, I did want to be passive, but I still want to be able to reach out. I know all of the GPs, so I can send them a text or an email and I'll get information, maybe better than someone who they didn't know before. But I look at the monthlies, I read every single line, because then I feel like I'm learning the asset class more by just going through and seeing what they're doing. So if I ever do want to become a GP, I can do it. But it often makes me just realize this is pretty awesome. Monthly, I'm just going to read how great it's doing because I made a good choice on the jockey, a good choice on the asset, and they're doing what they said they can do. And I think that's what I look for. But as he's saying, when you're taking in people who you feel good about, you're building a better relationship than, sometimes syndicators, when they start a new one, they got to get the money. So they're taking in more risk. And that first one is a little harder just with the people because don't you think LPs really need to know that the limited means something? Although you're open to getting something like that, most people just want to relax and, read what happens every month.
Yeah. I would say most people just want to be in the know.
Yeah.
They don't want to have to pick up the phone and call us and ask questions. Where's my quarterly distribution check? That is definitely not a call you want to get.
Yeah. It should just be coming in the email.
That's exactly right.
No problems for me so far. So what other properties do you like for your investors and what type of funds have you built? I think medical office was in there, retail we talked about. What else is going on? Obviously office, just in general, regular office, I think is a great opportunity now, but how about in your geography?
Yeah, so we have a bit of industrial in our portfolio. And the way our fund came together is we have a brokerage shop here, and everybody was kind of doing things on their own outside of the brokerage business and just running their commissions through the company. And we made a strategic decision in early 23, like, hey guys, let's bring this in and quote unquote institutionalize it a bit. I mean, we're not institutionalized at all, but we just have much better systems and processes, and we're still very relationship driven. And that has turned out to be really good for us because when you're just doing a deal here and a deal there on your own, it's hard to really package that.
Yeah.
And do it well and scale it. So, we've hired some great people. We brought on great partners. And it's that wheel is starting to turn. So we went from doing a lot of deals and syndicating deals kind of outside of our fund. And then we decided we're going to bring it in house. We created a fund, a customizable fund where investors can come in and say, hey, I want to be in deal A, not B, but I want to be in twice as much in deal C. That's been really good for us. And so as we think about assets, we have a little bit of a competitive advantage over just your typical GP, where we do have a brokerage arm. So we're seeing a lot of deals that our geographic footprint for a brokerage business is pretty wide. But the closer you get to our office, the more volume of transactions that there are. Yeah. But so you start to get a little outside of our office, and we've got great relationships with brokers, with sellers, with lenders. And that's really where we're finding the most opportunity. And because of our brokerage business and quick problem solvers, we kind of look for deals that across industrial, a little bit of office, retail. We don't have any medical in the fund yet, but we're looking at a lot of syndication has happened pre-fund there. Yeah. We just haven't found the right deals that will work. But what we kind of look for are deals in these asset classes that we can drive to, that have some operational efficiencies for us. Yeah. And we like deals that have a little bit of hair on them.
I hope so.
Yeah. We're not going to buy anything that's like 100% stabilized with credit tenants. That's going to be a low cap rate. We just can't compete there.
Yeah.
And we can't drive returns to our LPs there. We don't look for anything that's 100% value add. We like
takes too long for the LPs. Yeah.
Yeah, it takes too long, and it's too much effort. Really, it takes your eye off of everything else that's equally as important. So if you've got a fund and you've got investors that are some are in A, none are in B, and more are in C. Well, if all you're focused on is D because you've got this massive value add project, you can't take your eye off A, B, and C. You've got a fiduciary to these other people to perform there also. So we don't have enough scale or size in our company to really go bite off a big value add deal. So what do we look for? A shopping center, an office building that's got hair on it, that's got a good story, and we can, formulate our investment thesis as we're going towards LOI, further formulate it between LOI and PSA, and prove it out during diligence is really what we're after. And by the time we close, we're full steam ahead on proving that out.
Who usually
bring it to reality?
Yeah. Are you buying a lot from mom and pop owners? Or are you buying from like the owner after the mom and pop who just either wants to trade out or didn't operationalize correctly?
A little bit, all across the board. I mean, we have one large asset that we had the person that owned it rolled over 35% of the purchase price in equity, and as our sole LP. He just said, wow. You know what? I like you guys. I trust you guys. This is my prized asset. I'm going to let you, be the steward going forward. And that's great. That's turned out to be a great relationship with this investor. It's been a great asset. We're driving a lot of value there. So that one didn't really have any hair on it. That was just kind of an opportunity that presented itself at the right time, at the right place, with a long relationship with this investor. Another deal, a private equity company has bought the tenant, and they're looking to capitalize. So they do a sale leaseback direct with us without going to the institutional market or with a broker. And some mom and pop sellers in there also. I mean, really, we don't really care who the seller is. A lot of times, if it's a sophisticated seller, we like that because they're often willing. They know us. They know our reputation, and they're willing to roll over a little equity.
Yeah, and there's a lot of levers you can pull when the other side knows what they're doing and they know you know what you're doing, because you can go back and forth on what they need versus what you need. There's a lot of ways to mix that up. It's like, my dad used to do a lot of seller finance, and people thought it was so complicated. And I'm like, this is the easiest thing ever. He's just working out, do you want this price? I'll give you that price. I'm just going to get better terms. You're just moving stuff around. And I think with experienced commercial operators, even on the smaller scale, there's just a lot more things you can do that make both parties go, yeah, that feels good. Whereas residential to me feels more competitive, at least from my experience. And I have a brokerage and it's all residential. We do a little bit of commercial, but not really. It's kind of like residential, commercial, apartment stuff. But I feel like everyone's still fighting more in residential. Commercial, obviously, there's big players in it, but I just feel like there's more experienced negotiators in commercial, I would say.
Yeah. And, a sophisticated seller on the commercial side typically knows what their asset is worth. They're going to drive more value right out of the gate.
Yeah.
Which is fine. We're market buyers. We're not looking to, steal anything or take advantage of anybody. We do love a good deal. But with a sophisticated seller, if you come to them and you say, hey, you got 2 years left on this roof. This is a $300,000 roof. That's an easier conversation than going to a mom and pop and saying, hey, you got a roof problem. And we're not just going to inherit that. We're going to have some sort of price concession. So one party sees it as that this is fair and reasonable. One party sees it as I'm getting screwed.
Yeah. I mean, then they sit around for another year and realize they haven't sold because everybody else finds it too, or they find someone who just doesn't do due diligence. But, like you said, you're the steward for all these other people getting into the fund, and due diligence and kicking the tires is really the thing that saves them in the long run.
That's it. Yeah, exactly. So don't really care the type of seller, but you kind of know, we've been around, we've done it enough to kind of know how to position it. And a lot of times it's about setting expectations.
Yeah.
If it's a mom and pop seller, you say, look, this seems like a fair price for both parties, but when we get in here, we roll up our sleeves. We're going to peel every layer of the onion back till we get to the core, and we're going to expose potentially some problems with your buildings if we find anything that we can't absorb. We're going to have to figure out a way to co-absorb it.
Yeah, I find that mom and pop's books are not necessarily cooked, but they're just improperly done, meaning they're just, maybe they manage it themselves, so they don't count in, a management fee. And you're like, well, we're not managing this. So how are you, I would just remember I made 2 offers with my friend Ryan on direct to seller on self-storage facilities. And he was great about going through their books and saying like, none of this makes sense. They eventually both sold to somebody else. We made good offers, but I think that other person didn't make the greatest deal with them because you just read it and it was like all best case scenario for them. Meanwhile, you knew everything was, undervalued in some way.
Yeah. You never know what you're going to find on a P&L from a seller.
Yeah.
From a mom and pop, it might be kids' college.
Right. Exactly.
Wife's car.
Right. A lot of clothing going through here. Yeah. I mean, hey, that's why they want to get out of it. But we're not taking on that type of stuff as well.
Yeah, that's a great opportunity with a mom and pop seller to help them. It's a great way to build relationship equity with someone. Just to be honest with them, say, hey, look, you need to take these expenses off of here because your NOI is actually a little bit better. You know, and I think if you have that attitude going into the deal where it's fair for both parties, that goes a long way because every deal, I don't care how straightforward it is, something's going to come up and you're going to need something from the other party. And
I was a trial attorney for 10 years and, it's hardcore negotiation all the time. I was a prosecutor and a criminal defense attorney. And, when I looked at the time when I was doing off-market real estate or buying real estate, I was so hardcore because I couldn't separate them. And then when I left being a lawyer and I, doing real estate deals, I quickly realized, relax, man, nobody's going to prison because the way you negotiate really depends, one, who's across the table. I mean, obviously if you're trying to get a deal, but I had to learn over time that, like you're saying, I was never dishonest. I was just more too tough because I was so used to it.
You either won or you lost.
Yeah, right. I mean, I felt like everything was like, a prison sentence or I'm going to, someone's going to go free. But I really think what you said is you really want to set a win-win, cooperability. And if it doesn't work out, no problem. I think one of the things that I'll want to get your take on it as well. For me, I think that the biggest power investors have is the ability to walk away. And it's helped me so much over the years to walk away from deals. And then someone's like, oh, well, what if you find out later that someone crushed it on them? I'm like, great job by them. It just, the timing wasn't right for me. And either I didn't negotiate or I didn't like how they were negotiating. Do you think that's important for investors to know, especially now? Like, if it doesn't feel right, you don't need to buy it.
No, for sure. And I think being forthcoming with information throughout the process, even before purchase or contract, is really important because it sets the tone for the rest of the process. Now, sometimes it's really competitive and you've just got to get in there and you got to get something inked. Don't like those situations at all. And quite frankly, we're not typically a buyer in those situations.
You'd have to know it's the property, like either location or something about it is just, you can't miss, something's going to be in there. Cause I don't like that either. I hate feeling pressured.
But I was having a conversation with my partner today about a deal that we offered on, and we were trying to educate the sellers on, hey, look, this isn't a $7 million asset. This is maybe a $5 million asset, and which is why we offer 4.8.
Yeah.
And we were trying to educate them, and it kind of upset them. They didn't understand why. And it's looking like it's going to come back around. Found out today, like, hey, they really appreciated our honesty. We exposed all the things about the asset that we found during our initial diligence. And, because of that, there was probably several other people at the dance at around that number.
Yep.
And they said, look, if you can get to $5 million, we could probably figure out how to make this deal happen. And, I think they came back to us because they trusted us.
Yeah.
And we didn't feel like we were trying to just beat them up. So if you're going to go in with a low offer, what's going to be perceived as a low offer from the seller, you better be able to back it up, and you better just go ahead and give them the backup when you present the offer.
Yeah, I couldn't agree more. And that's my same philosophy and always has been. I won't even present like lowball offers for clients who have no reason. I'm like, if I can't justify it with data or repairs, I'm not sending this. You're going to make me look dumb. When I do it for myself, I do the same thing. They're going to get a 2-3 page thing on why the number's out of, because I know they're going to be offended. But like you said, they're going to get over it, because I always say the next person, if they do their due diligence, is going to find the same stuff. So you're either going to encounter this again and be on the market longer with people looking at a lower price, or you're just sitting there hoping that someone doesn't do the due diligence and you slip it by somewhere. And I don't think that's the greatest way to do business. And that usually, again, they may not like it at the time, but I agree. A lot of them come back, or they just appreciate it and you actually become friends later. And they find someone else who buys it with less due diligence. I mean, good for them, but not my thing.
And I think, all this is generally data backed, fact backed, reasons why, we're coming to this price or we don't like the asset. But I will say there's also like the gut factor.
Yeah.
And that's hard to really communicate to a seller. There's really no way. But I do think there's something to trusting your gut.
Yeah.
Sometimes you look at paper and, man, this thing just makes all the sense in the world, but it's just you don't have a good feeling about it. Maybe there's something that was said in a meeting or just something that you've heard through market chatter, or just maybe it's just death by 1,000 cuts. But sometimes you really do just need to listen to your gut, because, like I said earlier, you're never going to bat 1,000. You do this long enough, eventually you're going to do a deal that doesn't go the way that you thought it was going to go. A matter of fact, none of them do. They are usually a lot better, or maybe not quite as good. Hopefully they're not worse. But just trusting your gut and being able to say no. I mean, there's been, I think that's probably one of the hardest things for me is just, we have our investment committee here where we talk about deals, and just throwing that on the table sometimes when people are so invested in a deal, or they're excited about a deal, and just being like, it just doesn't feel right. There's something about this or that or the market, or just, this happened on this last deal. We really need to make sure it doesn't happen on this one, and it's got the potential to. And sometimes, that's the best thing to do is just to walk away. And a lot of times the deals will come back around.
Yeah. And I think trusting your gut is something that you have to build up. Like we grew up with dads who had properties that helped us get more reps early just by being around real estate. But new people, you got to make some offers. You got to be in the room. You have to know some partners, have some friends who have done many more deals than you, so you can get more of that kind of passive knowledge from them. Because it's hard to say if you've done one deal and you're offering on one, like, I don't know, how good's your gut? Probably not very good. Person to person, maybe you sense something about the person, but a lot of people get so focused and commercial on the spreadsheet that it looks so good, they bypass this. Well, this person just seems a little shady for me, and then you get in the transaction, there's huge liens on the property that they didn't tell you about, and they're still not running away. But the spreadsheet looks so good.
Right. Yeah, that's very true. And I was telling somebody the other day, I do miss the days of just being a younger business person. because being a little naive is kind of nice too, right? You don't know every single gotcha around the corner. So sometimes you overanalyze things too. I mean, you think back at these houses that were $25,000. I'd probably never do that now.
Yeah, right. I was just right when you were saying, like, I was thinking of just going in basements, because now I can go, I'll find something wrong in every basement. Sometimes it's just like, all right, some stuff's just old. Houses are old, properties are old. Again, another thing though, you learn with more reps. It's like some things you accept. A roof that's, 10 days from failing, you don't. But 4 years left on a roof, what do you really expect of the seller? It has 4 years left, could be 10 years. You don't know.
Yeah. Well, I think we typically find them when they're like 2 years left.
That's like very close to the negotiable window.
Right.
You just need a little bit of a leak somewhere.
Yeah, exactly. Yeah, 4 or 5 years, just like, it's kind of like dealer's choice. You never know.
Yeah. Well, so if we're talking to investors out there of any age, but who want to start putting their money to work, where do you think the best place to get their money to work is now? Maybe they have some experience. They're well capitalized. Based on what you've seen in the last few years in your market, where do you think they should go?
This is going to sound like a bit of a cop-out, but we'll dig deeper into this. But you need to put it with people that you trust.
Yeah.
If you're going to be an LP, like crowdsourcing, crowdfunding, like all these things, like there's no way in hell I would ever put my money into something like that. Like especially early on. And there's a lot of great people out there that are crowdsourcing, crowdfunding, whatever you want to call it, for deals that are legit, great operators. But if you're a new investor, invest in something that's close by. Yeah, invest with people that invest with people that you trust. And one thing that I often tell new LPs, like, investing in a deal with us is not a ticket to get educated on how to invest in real estate. We want to bring you along for the ride, but like some people see it as, okay, here's an opportunity for me to go learn how to do this by investing $50,000 in this fund. And that's really not what we're here for. But so I tell my peers all the time, invest with us or invest with somebody else that's in this market. Here's 2 or 3 other people that you can invest with. But they're straight shooters. They're going to tell you the good, the bad, and the ugly. And the bad and the ugly is really what you need to know when you're investing in these deals. It's easy to make a deal look good. You can financially engineer a spreadsheet. 50 basis points on the exit cap rate can change the IRR by a mile. And we see that all the time.
Well, I had another guest on. He's like, you never see a pro forma come out and it's like a 1% IRR. Like, there's no such thing. Everything's, 20% and up. So it's nice to be able to have. But I think trust is everything. When you read Brian Burke's book, A Hands-Off Investor, about being an LP, it's really about trusting that person at the top, the jockey. How do you feel about it? And then are they willing to give you the time on the intake, or are you talking to a VA or something? That doesn't give me the good feeling that I'm going to be able to get anywhere with my asset later.
I think spreading it out is a really good idea for new investors also. So across asset classes, across different investment opportunities or GPs, if you've got, let's just say $200,000, like, don't put all your eggs in one basket. Maybe
that's
hold a little bit back.
That's 4 deals. Like if you want to play the 50,000 game, you can spread it out really nicely and get a nice spread on different types of properties.
Yeah, we really like this customizable fund thing that we have going, and it gives these investors an opportunity to have that control. Yeah, where they say, oh, you know what? Man, I live right around the corner from this office building. I know it. My wife works in it. Whatever it is. And so I want to put 50 in this or 75 in this one, and I'm going to save 50 for till I see another deal that I like. So they might wait 6-9 months. 5 deals later, they find a deal, then they invest in that one. So that's a nice way to spread your risk out versus giving somebody $200,000 into a blind pool and they go out and deploy it however best they see fit.
Yeah. I agree. Awesome. Aubrey, is the best place for people to find you guys at ltpcommercial.com?
It is. Yep.
And that stands for Linville Team Partners.
Linville Team Partners Commercial. Yep.
Yeah. And who are your ideal clients? Because I know you have a brokerage also. So who do you want to reach out? Like, what types of people are you working with? I know we talked about a little before.
We do a lot of work in the retail industry. So if you want to just slice what we do here at Linville Team Partners, we're a brokerage team. We do a lot of investment sales. We do a lot of tenant and landlord rep. And kind of the closer you get to home, the more landlord rep we do. Investment sales kind of all over the Southeast. We have our investment platform, and then we do a tremendous amount of work with retailers throughout the country that are in acquisition mode, that are doing roll-ups. So looking for EBITDA to buy. So, hey, if you're an investor, reach out to us. If you're a retailer that's interested in doing roll-up, finding an EBITDA to buy, we're the best people to call for that. But so we're pretty diversified. We've got 2 offices. We're in North Carolina and Ohio, and we've got about over 40 people working in these different business units. So I've really enjoyed our time today, Jonathan. Too. I appreciate you having me on. You seem like a great guy.
I appreciate it.
I picked up a lot of wisdom just talking to you today. So hopefully I was able to give you a little bit.
Absolutely. Yeah. The thing that I noticed right away about you is that you're definitely trustworthy. You know, like as we get older, you can tell like if people are putting on a shtick. You're just not. I mean, I can just tell, and I'm sure the listeners can get that as well. But yeah, I really appreciate it. Great conversation. And I look forward to staying in touch. I'm sure we will.
Yeah, please do. Take care.
Yeah. All right. That was Aubrey Linville. He is a co-founder and partner of Linville Team Partners. Again, you can find them at ltpcommercial.com. I'm Jonathan Greene. We'll see you next episode.
Thanks for sticking around to the end so you can get a preview of who's coming up on episode 322 of Zen and the Art of Real Estate Investing. It's Ashley Garner, and it's another North Carolina show. Ashley is the founder of ABG & Associates. He's an experienced and successful investor with over 3 decades in multifamily. He owns and operates a portfolio of more than 130 units in various locations in 2 states. He runs a brokerage. This is a great show. You're going to get a wide view on what real estate is when we have these shows where people also have real estate licenses and brokerages. We'll see you next episode with Ashley.